All right, now we all know.
Yeah.
Um, so generally, and Tammy, if you could just advance to the next one. What I'm going to be focusing on is really the PNC Opportunity Zone Fund. I am not an attorney. I am not an accountant, so the IRS tax code is really not what I'm most familiar with. But back in 2017, the OZ legislation was part of the Tax Cuts and Jobs Act. So the intention was really to spur development in low and moderate or low income communities specifically. It's expanded a bit. It does include some moderate income census tracts, but essentially the governors of each state were required or requested to identify 25% of each state's low income census tracts to be identified as qualified opportunity zones. And currently, there are more than 8,000 census tracts identified across the country. Next slide. So, what qualifies for an OZ deal, essentially? So, for the PNC fund, it must be a qualified community development project as defined by the Community Reinvestment Act. Now, this is a PNC imposed requirement. So essentially, the legislation states any opportunity zone investment in a qualified OZ or in a qualified OZB, which is an OZ business, will qualify for CRA credit. PNC took a much more narrow point of view, and we decided that it's really got to meet the needs of the community. So we're not going to go into a low income community and build a new sports arena or a guardian self storage facility because we don't necessarily see the inherent benefit to the community. So we're really focusing on the traditional buckets of community development. And essentially, those are affordable housing, stabilization and revitalization, community service. Economic development is also included in that in those buckets of CRA qualified investment. However, we don't focus on that in my group because it's really managed by our SBA lenders. That's really a loan or an investment to a small business, somebody who's making less than $1 million a year, has fewer than 500 employees. So there are certain metrics associated with that economic development bucket. But my group really focuses on these three: affordable housing, stabilization, revitalization, and then community service. So what qualifies? Really, for affordable housing, it's going to be a voucher-based thing. Either the project itself is identified as with a project-based voucher, or the units, the residential units, accept vouchers for rental assistance. Otherwise, we can do a naturally occurring affordable housing calculation, which is basically 30% of 80%. So we look at the area median income. We take 80% of that area median income to identify the moderate and below moderate income individuals and families. And then 30% of that is what's really allocated to make or identify an affordable rental rate, because no family should be spending more than 30% of their gross on their housing. So that's really how we come up with that naturally occurring affordable housing metric. And then for PNC, we are only investing in real estate development projects. So the metrics there, the property has to be acquired on or after 12/31 of 17. And you have to double the basis of the structure on the property, not on the land, just on the structure. So next slide. Thank you. So again, what qualifies? It's real estate on or after 12/31/17. And for those that are not overly familiar with the legislation, again, I can't stress enough, businesses also qualify, but PNC chose to go with real estate only just because it's collateral that can't leave the census tract. It's much easier to track. And it's what we were comfortable with as a lender and as an investor. But again, operating businesses are also an allowable investment. Opportunity zones must, or the funds must be invested as equity. Projects have to be shovel ready. Substantial improvement. I'll get to the calculation on that here in a second. It's pretty simple. And then community development, again, as defined by the CRA. So this is what we would love for a project to look like. And this is in a perfect world. So in a perfect world, we have a $10 million project and we have a $10 million appraisal. So that means there's no gap and we can max out our investment and our debt. It is a two-pronged approach from PNC. So in this example, we have created an SPE, a single or a special purpose entity, to own the real estate itself. The managing member is going to come in with 10% equity. The investing member or the PNC Opportunity Zone Fund would come in with up to 70%. And then the debt is going to cover the remaining 20%. So again, in this perfect world scenario, you've got $1 million from the managing member, a $7 million equity investment, and a $2 million piece of debt. And then this is going to show us exactly how that breaks down and what it's going to look like. So the preferred stock and the debt are actually going to be based on the fair market value, not the cost. So anybody who does real estate development has heard the bank say, we will lend you up to X% of the appraised value or the development cost, whichever is less. So in this example, again, perfect world, we've got an appraised value that matches our project cost, so we can come in with the total $10 million. So in this example, we've got the land valued at $500,000, the acquisition of the structure at 2.5, construction cost at 5, soft costs at 1.5, and then the contingency of 500,000. So that gives you your $10 million project. And then the note here, how do you double your basis? It's, again, a very simple calculation. So here we have a total acquisition cost of $3 million. But the IRS determined that in order to double your basis, you have to substantially improve the structure on the land only. And in this instance, that structure was 2.5 million. That was the value going in. So that means you have to spend $1 more than the acquisition cost. So if the acquisition was 2.5, you have to spend $2,500,000 and $1 to improve that real estate on the land. So if you have a vacant piece of land, you're automatically going to double your basis and you don't have to consider that. But again, if there's a structure on the property, then you do have to consider that as you start sitting down and hashing out your numbers. Are we spending enough to improve this property to double our basis? And then this is just a breakdown of really how the numbers hash out and what it can look like to the project, and how you can see how it's advantageous to the project because the bulk of the capital stack is coming in the form of that equity investment. Now, it is a preferred equity investment. And in this example here, we're looking for a return of 4.5%. And the debt service side, it's priced at 5%. Obviously, those rates aren't really where they'd be today. We'd likely go into pref at 3.5 or 4% on the return for the equity. Debt's going to be priced much lower just based on where we are today. But when we underwrite projects, we're going to stress those. We're going to really push the limit to make sure that the project can perform, because when we sit down at closing, we're going to close the debt on a variable rate, and the price won't fix on that interest rate really until it converts from a construction to a permanent facility. The other kind of nuance to this program is, again, typically with a real estate development in the commercial world, you can have a 5 or a 10-year term, but you can amortize that over a much longer period of time, 15, 20, 25 years. Well, with the PNC debt in the Opportunity Zone projects, we're looking to fully amortize that debt, because in year 10, we want to have our investment taken out. So we don't want to have to worry about the investment and a balloon payment, because we have to reprice it. We have to make sure that the project can support it from a collateral position and from a cash flow position. So we're looking to go in and be comfortable today that 10 years from now, we'll be able to get our equity out of that and refinance that equity into a very traditional commercial real estate structure. So in the instance of all of these examples, we're basically looking at an 18-month construction and stabilization period, which would lead to an 8.5-year or 102-month amortization, fully amortizing loan. So once your loan converts from the construction to the permanent, you're only looking at P&I payments based on an 8.5-year amortization. So again, that's just, it's a very unique position for a real estate structure to be in. And the dividend is a very flat calculation. It's based on the entire equity investment. It's calculated annually and divided by 4. So we're looking for quarterly dividend payments on that equity investment, and that is a preferred investment. So when we look at the numbers and how they break down into a real world scenario, when we're looking at low income areas and real estate development, we are rarely looking at a project that doesn't have a gap of some sort. So in this example, I've really come up with the same total development cost of 10 million, but now we've only got an appraised value of 800,000. So my 10-70-20 structure on 10 million worked perfectly, but now I can only do 70% in equity of the 8 million. And you can see that comes to 5.6 million. And my debt at 20% is again of the appraised value. So it's only going to be in at 1.6 million. So we now again have this gap, and how do we fill it? And what do we have to do to get where we need to be? And again, in this example, the developer doesn't necessarily have $1 million in cash. So they've got to kind of cobble it together with cash, grants, private equity, and pull together their 10% or their $1 million. So this one is fun. This is most often what we see our flowcharts looking like. And it's just a different representation of the table shown on the previous slide. So again, you've got your SPE owning 100% of the real estate development. Your managing member, instead of just being the $1 million in cash, you've got 3 pieces feeding into that $1 million. You've got 250,000 in cash, 250,000 in grants, and then a private equity investor coming in with another 500,000. And again, because I'm limited to basing my investment and my debt off of that appraised value, the investing member is only coming in with 5.6 million in equity and 1.6 in debt. So where does that other cash come from? Well, we're going to come in with subordinate debt of 1.3 million and an economic development loan of 500,000. And this is where we often work with our community partners. So we're going to look to our CDFIs and our government agencies. Here in my neck of the woods, we would potentially work with Bridgeway Capital, who's a local CDFI, and perhaps the Urban Redevelopment Authority of Pittsburgh or Allegheny County Economic Development would come in with that economic development loan piece. And again, on the next slide, we can see how that's going to break down into returns in cash. Private equity, you can see there in the middle of the page, is going to fetch a much higher return than, the PNC community development equity. So where we're still at 4.5, that private equity may be looking for a return of 8.5%. Subordinate debt is traditionally priced higher than bank debt. And the economic development loans are traditionally priced lower. They're much more patient. So in these instances, there could be a long deferral period where, no payments are due perhaps until year 5, or it could be a cash flow note. So there are a number of different ways that our partners can get comfortable with coming in and partnering with us on these transactions. I keep trying to advance the slides on my own, Tammy. Thank you. Doing great. So again, you can see where we come in with a 102-month fully amortizing loan of 1.6 million. The monthly payment on that is pretty hefty at 19,000. The PNC dividend payments at 4.5% on 5.6, again, 63,000. So what we do is we look for the project to perform just to cover the PNC debt and equity, because our debt, of course, is going to be in first position. Our equity is a preferred equity position. And then again, we do depend on our partners to be a little more patient, and wait their turn, get in line, deal with an excess cash flow waterfall, which really helps us to make these projects work. And then the next slide just shows, again, the cash flow from or the requirements from the private equity, subordinate debt, and economic development. So you can see that in this instance, we're still looking at payments upwards of $500,000-$700,000 really, on an annual basis. So that's what we would be looking for in net operating income from a project to make sure that we could cover these various sources. So we've closed on a number of projects since the inception of the OZ program. They're across our entire footprint: Pennsylvania, Michigan, Wisconsin, Ohio, Alabama, Illinois, which I spelled wrong, excuse me, New Jersey, and North Carolina. I've included a few here, and they are all local. Some of you, especially in our Philly footprint, might be familiar. So 2120 East York Street, this was the redevelopment in the Kensington neighborhood in Philadelphia. Mixed use project. It had 56 residential units, and this did target residents at 80% of the area median income for the Philadelphia market. And the retail space there includes a credit union, floral shop, and a fitness center. So this is completely done, up and running, and it's performing very well. We were really excited. This is one of our first projects. And we had great partners all around. Everybody was getting their feet wet at this point. Kathy Niederberger, who is the head of community development here at PNC, actually, kept saying, we are building this plane as we fly it. And this is a perfect example. Again, one of the first that we went in with. And you can see it wasn't a perfect scenario where it was just PNC coming in. We've got the additional investor in here, in addition to the managing member equity. So, we do have to learn to play nice with others, because this is not, again, a traditional commercial deal where we make a loan and we walk away and the developer makes the payments. We are an owner in these projects. So we have to make sure that not only are they responsible development for the communities we serve, but that they're going to perform well and that they're going to continue to perform well. So, there's not necessarily a rent restriction or a deed restriction like there would be in a LIHTC scenario, but we are there to kind of be a watchdog to make sure that these do continue to maintain and perform as we anticipated going in. The second one I've included is the Brinker Lofts. So this was actually I think it's on the campus of Lehigh Valley, and it was a cold storage building, and it had been vacant for decades. It had been used just for regular storage. And again, this was converted into 31 market rate residential units. And the first floor retail, there was an outdoor deck, on the second floor, excuse me. So we qualified this for CRA based on that stabilization and revitalization of a low or moderate income geography. And how we do that is we really look at the community's master plan. So we go to the community and we make sure that the master plan we have has been adopted by council or the borough or the municipality or the city, and that there is a need for market rate residential. There is a need for whatever the proposal is. It could also simply be the fact that this Lehigh Valley cold storage building was something that the community wanted to maintain and have and revitalize, and not just have vacant or demolished. So those are the ways that we can qualify based on that CRA metric. And then the last one here is the store in Fisher. And again, this is in actually the Scranton area. And again, we've got mixed use. So this is 65 market rate residential units with 8,000 square feet of first floor retail. So the property again was qualified based on that revitalization and stabilization. And it was the location is what determined the CRA qualification for this one. It was really at a gateway to the area. And again, the city had identified this as needing to be renovated and revitalized. So we were really excited for those 3 projects to be among 3 of the first that we've done. And I wish I could offer you exact metrics of how much we've invested and what it's leveraged. It's my understanding it's upwards of $250 million at this point. But we are still waiting for the second quarter end numbers to come in because we've closed a couple more OZ deals this year, which again has just served to leverage that much more. And again, I do want to point out in this example, in addition to the OZ investment and the PNC debt, we even had the historic tax credit equity involved in this and a member loan. So that came into play because the project had overruns. And because we had priced it based on that appraised value, we knew what we could invest. The members, the sponsoring members had to make up that difference. So they were able to pull together that additional $160,000 that was necessary to really get that project over the line. And I think that the last point that I want to make is probably one of the most important, and it's one that we really try to hit home. Opportunity zone funding does not make a bad deal good. We get a lot of calls saying, it's even internally from our internal partners, hey, my client has this project, we can't make it cash flow, can you do it? No, it doesn't work that way. But what it does is it supplements the project, it makes it better. It makes the cash flow position better for the other investors. And hopefully, you know, what we like to see is that it really offers something to the community that will be there and that will last. So that is what I have to offer here, but I'm happy to answer any questions if there are any. Elaine has one.
I have like 10, so you'll have to stop me.
Take your time, I need water.
Yeah, take what you need. I apologize if I missed it, but just sort of some logistic stuff, knowing that this is PNC specific, like other people may be different, but do you have like a minimum percent equity? It looked like you were willing to go up to 70%, but do you have a minimum set or like deal size minimums? And then what is the sort of process? Like how do you pre-qual or sort of vet deals?
Sure.
Like how does that flow?
Great questions. So yes, we absolutely have a minimum. And when we started this process, believe it or not, it was $1 million. We quickly realized that was way too small to make this economically viable for our borrowers, just based on the costs associated. It's not new markets legal, but you know, the legal costs can be extensive. This is not something we document internally. We're talking about drafting operating agreements with developers and joint ventures. So we do use outside counsel. And as we, you know, close the first few, we've gotten to a point where we have basically template documents that we can use that has drastically reduced costs. But the quick answer is $5 million. That is our minimum project cost. That can be, I'm sorry, I shouldn't say project cost. That is our minimum PNC all in. It can be a mix between debt and equity, but we don't want to come in with less than 5 million because otherwise we're charging you more than it's worth, if that makes sense. And what's the process? Wow, it depends. Isn't that the banker's answer, right? So essentially, if we've got a shovel-ready deal and we know what we need and we've got drawings and we've got developers that know what they're doing, and oftentimes we don't. We're working with some community groups that are really kind of cobbling these things together and working with various partners and consultants. That takes a lot longer. But if we're working with, you know, again, a developer who's experienced, knows what they're doing, they've got everything lined up and ready to go. Once you get to the permit point, we can turn this out fairly quickly. I would say no less than 6 months, though. I would say that's a comfortable place for us to be. Because once we have the full package, we get it to underwriting. Underwriting does their thing. We bring in the real estate analysis team. We do a market study to make sure that the numbers are what we think they should be. And we have to make sure that the drawings and the costs associated with those drawings are realistic. So we're going to do a third-party plan and cost review. We're going to get our inspectors out. So all of those things, do have some lead time associated with them. And there's there's steps before you can get to pulling that trigger. So I'd be comfortable with a good complete package coming to my desk today and closing by the end of the year. That's it. I nailed it then.
Can I do one more?
Yeah.
Could you the double your basis question? So this is not a tool that can be sort of an acquisition and hold or, very light rehab. This is intended for pretty significant amounts of work.
It is. And I would really stress, maybe Michelle can weigh in here if she's comfortable doing so. 24 months, I think, or maybe 36 to double the basis. Sorry, Michelle's off camera. She might have stepped away, but I think that's the metric. So yeah, it is not a buy and hold. It is on the other hand, Elaine, a buy, renovate, and hold, because we want to be in the investment for 10 years.
And new construction is also fine, right? Vacant land.
It is. It actually makes it easier to double your basis, because if you acquire the land and it's vacant, or if you're demoing and reconstructing, then yeah.
Got it. Thank you.
And when I was saying that everything is based on that appraised value, I do want to stress as well, it is the stabilized as completed market value. So even if we're looking at an affordable residential structure, we are going to have it appraised based on those affordable rents, but we're also going to have it appraised based on market, hypothetical market. And that's what we are taking, that highest level of the appraised value, because there's no nice way to say it, but if the entire thing collapses and we have to foreclose and end up holding it, we know what the value is that we can sell it for. So we will base it on that higher level, which really gives the project the benefit.
Hi, I'm sorry I was late.
No, it's okay.
I was finishing up my board meeting, but I didn't want to miss this. And so I missed parts I'm sure were very, very important, because I was very interested in this. Are you going to be able to, I see this is being recorded, so that's good, but are there any handouts or anything that could give me some of the information that you were talking about? Because I am really interested in it.
So my slides will be included in the recording. I will see if I can get clearance to email those as well.
Okay.
I have to get permission.
Of course.
From ethics and communications.
You work at a bank.
I do.
That's a given. Okay.
But yeah, I will certainly ask that for you, Jackie.
Okay, thank you.
Yeah, and if there are any specific questions, we've got time.
Okay.
Jeni, I have a quick question, or maybe not a quick question, but how have you seen opportunity zone funds and LIHTC kind of work together, or do they?
They do. There is absolutely no restriction from the IRS. You can allowably use both.
Okay.
We don't play well with them. We really don't, because it messes up that ownership structure for PNC OZ fund coming in as a preferred investor. We don't have a level of comfort there. Same with new markets, because with the new markets, the CDE has the rights to the real estate. We can't perfect our lien. We have to do a 7-year forbearance. 7 years is a long time for a bank to say, we'll see if it works. So yeah, we have not found a comfort level with those, but I've seen plenty of other projects without PNC in them that do use both. We did find a minimal comfort level with using historics as long as they're coming in upfront as equity and not being depended upon as a piece of the cash flow.
Okay, makes sense. So other funds may have different
Absolutely.
internal
And
requirements.
I would
Okay.
absolutely recommend that anybody who's interested in learning more about that, take a look at the Novogradic website. It's novoco.com, novoco.com. They've got a great resource page for all tax credit and tax benefit programs. And I know Cohn Resnick does as well. And they've got all sorts of resources and different ways that you can piece these together, including a list of funds that are out there. And they list them with either their preferred geography or a niche. Like there are funds out there that are only looking to invest in socially responsible operating businesses or in tech or in real estate. So it's a really good resource.
And this is maybe a follow-up question. If PNC was the equity investor in the LIHTC and the OZ fund investor, it still doesn't work for your ownership structure?
We haven't done it yet.
Okay.
It's been looked at, it's not been closed on. So it's not something that we would say, no, don't call back. You know, we will look at it, but again, you know, things move slowly in a bank.
Gotcha.
So
Oh, yeah.
when you're looking at getting your project done, you're like, does this work? Sometimes it's a lot easier to just say, maybe not.
Yeah. Thank you.
It was, there used to be a sort of sunset date for the program. There was like 7 years, you had to hold 7 years. Yep. And then where is that? I know that's sort of on the investor's return side, not the making a deal work side.
Right.
Are there deadlines, dates?
The first sunset is 12/31 of this year. So we do want to deploy as much as we can during 2021, because if we do, we're still going to get what they call a 10% basis step up. It's a discount. So if I invest $1 million into the project, $1 million in my capital gains as an equity investment. When I go to pay my tax on that capital gain, I'm only going to pay tax on $900,000 of it. So that's the first one. The second one is our taxes are due as of 12/31/26. So we are, from now through when we file our 26 taxes, we are getting the benefit of the, you know, time value of money. I'm using it now, it's earning me money now, and I'm not paying for it for another 5 years, right? Our goal is the 10-year hold period. And in 10 years, what's going to happen, again, we'll just use that $10 million example. And in that example, I invested $7 million. So in year 10, I'm going to get my $7 million back. I will likely be my own refinance source. I will do a very traditional real estate commercial real estate loan on that, 5-year term, 30-year amortization, 20-year amortization, you know, what have you. And that will get me my preferred equity investment. So I get my principal back on that. Then when we closed on it today, it was worth $10 million. Well, 10 years from now, perhaps it's worth $12 million. So in addition to my equity, and this is PNC's fund again, I am looking to get 10% of the increased appraised value. So the increase in the appraised value is $2 million. I'm looking to get 10% or $200,000 of that. That is capital gains tax free. So that's really where the benefit lies, is in holding that for 10 years and getting that tax-free money at the end. That does not sunset until 2046. So we could make an investment in 2030. We're not going to get much benefit other than, again, we'll have that time value of money. We'll be earning money. But in year 10, I will get, hopefully, 10% of an increased appraised value at a tax-free basis.
Jenny, I have a maybe random question. I know this is not really for forced sale or home ownership, but are there any creative ways that you've seen this be coupled with affordable ownership? Like if there's a 10-year sale restriction or some way that, you stay in the deal for the required amount of time?
Yeah, sure. We haven't done it, Angela, but I've seen it. So exactly to your point, there's a 10-year hold period. So we have to remain a partner in the ownership structure. So perhaps it is a first-time home buyer program where it's 10 years of making payments. And at the end of 10 years, those payments have gone to your equity. A portion of that goes toward your down payment. Rent to own is really the only way I could think to say it. Nobody really likes that phrasing, but that's essentially what we have seen. Again, we have not entered into any operating agreements that would allow for that, but we have definitely seen them.
I got one more question, and maybe the Novogradac website, that was a great tip and maybe it says it, but do you guys only do deals when you're both debt and equity, or will you consider just doing equity by itself if that's all?
No, we have to do both. Believe it or not, we are more well protected as a lender than as an owner in the project. So that's really where all of our covenants are enforced, is in the debt documents.
That makes sense.
Yeah. Yeah, people much smarter than me came up with this structure, so.
Okay, any other questions for Jenny? It was a lot of information, Jenny. I think too, we're all processing. Great.
Thank you.
That was awesome. Okay. Well, in the interest of time, we can let everybody go. Really thank everybody for coming. We're taking July off for their third Thursdays, right, Jenny and Penny?
Yep.
Yes. Okay, I'm getting the nods. And I apologize. What do we have scheduled for August? Has that been confirmed yet?
I think we are still toggling between two, Penny. Is that right?
Yes, we
Okay.
we are thinking that Angela and her committee that's working on the guarantor fund with PHFA. We're thinking that if that's at a point where it's worthwhile discussing it with the group, we have Robin Weissman from PHFA, I think, invited to do that with some of the committee members, some of which are on our steering committee as well. So that is our plan for August. But if something changes, that it doesn't make sense to talk about it in August, we could bump it to September. In which case, I think we decided that Megan Kreider at FHLB will be jumping in to talk about some new rules and application rounds at the Federal Home Loan Bank. And if we can get, if the PHFA one, the guarantor fund comes in August, then I think Megan has agreed to be flexible, so that we could swap at the last minute. But we're going for the PHFA one in August right now.
Great. Thanks, Penny. So August and September will be some great content. Thank you. And we also have WHF for members. We do a WHFA Wednesday, which is the first Wednesday of every month. It's very informal virtual networking, just kind of touching base. We talk about industry content, industry news as well. You get to learn a little bit about each other and what's happening in the industry, which is a lot of fun. It's just 30 minutes at noon, the first Wednesday of every month. So thank you all for joining us. This was a lot of fun. And thank you again, Jenny, for being our speaker and teaching us all about opportunity zones.
Absolutely. Thank you, guys.
Thank you guys. Have a great evening.
Take care.
Thank you.
Bye.